and monitor the fund's performance. But they don't make day-to-day investment decisions. So in simple terms, a GP runs the fund and makes investment decisions, while the LPs provide the money and hold the GPs accountable for delivering returns. So hopefully that sets the scene. And with us today, we've got four of the most experienced and insightful panelists. First up, I'd like to introduce Egla Ntumba, and she brings insights from managing misfit ventures and shaping fund strategies for African SMEs. We've also got with us Biola Alabi, who is investment partner at Delta 40 Venture Studio and a general partner at Acacia Ventures. She's a seasoned investor and venture builder who's backed over 50 startups, bringing deep expertise in inclusive innovation, cross-sector capital flows, and building trust-based investment networks. Next, we've got Michael Muti, who works across multiple African markets at Launch Africa with hands-on experience in fund deployment and investor relations. And lastly, we've got Natasha Kovinas, who is Principal Investment Officer at the Venture Capital Department of Proparco. She leads the early stage equity transactions across Africa and co-leads the Choose Africa VC program and manages the ARE Scale-Up mandate, bringing institutional investors' perspective on scaling funds and ventures. So yes, lots of good insights lay ahead. Maybe let's get into it. First up, just some opening reflections. To the panel as a whole, what does fundraising in Africa feel like today? What surprises, frustrates, or excites you about the current environment?
I mean, I'm happy to go first since I'm unmuted already. What's been surprising to us is the interest that we've received from international high net worth individuals. So we are a Misfit Ventures. We are a private credit fund focusing on flexible working capital to female-led SMEs. So when we started fundraising, we had a stereotype in our minds of who the people were that we were going to get capital from. But, white American male was not at all that stereotype. But those were the early backers that we got, and that was really surprising and interesting. Another one is probably just, yeah, I think that's definitely one. But also appetite for private credit has been a really welcome surprise that we found amongst institutionals and sort of retail investors, high net worth individuals and the like.
Super, thanks, Egla. Biola or Michael, do you have any further thoughts on the topic?
Sure. Look, I think fundraising is still a bit of, a little bit of Survivor mixed with Game of Thrones, mixed with like I guess hand-to-hand combat and some like highlights and I mean lots of highlights and lowlights. And I think that just in the same way Egla said, there are always going to be surprises along the way, but there are also going to be a lot of disappointments. And I think that is still the landscape today. It is still a very long process, a very challenging process, and full of stories. I mean, you have to really understand the story and understand the LP and make sure that it is a really good product match with your fund and the LPs you're speaking to. So a lot of homework, a lot of work every day. Yeah.
Absolutely. I like the Survivor Game of Thrones analogy there, Biola. And Abu, just to double click on that, I think the biggest surprise, at least for Launch Africa, and maybe to give a bit of context, we are a largely retail investor-backed fund. We are currently in our second seed fund. We raised our first seed fund between 2020 and 2023, which was backed by a total of 238 LPs from across 40 different countries. And the same has continued in Fund 2. So we are yet to have a big anchor investor similar to our ecosystem stakeholders in terms of the other investors on the continent that have, that have been fortunate to have a big DFI with a big ticket. We are still largely retail backed. So that's your family offices, philanthropic organizations, foundations, high net worth individuals. And so in total to date, across the two funds, we have just a little over 300 LPs from about 50 countries globally. And that's mixing the US, Europe, Asia, and Africa. And I think what was frustrating for me, at least in the beginning, was the perception of risk versus the reality on the ground. But to Egla's point, when you're on the ground speaking to potential LPs, especially in the international scene, and you do that bit of educating this group of investors in terms of what is the reality on the ground from experience, and obviously demonstrating that with numbers and traction, that perception shifts. And it goes from seeing a high risk geographical positioning to a very strong potential return on investment when it comes to considering VC as an asset class on the African continent. So it's a mix, reinvention, resilience, and obviously it cuts across founders. I love founders, so I'll try as much as I can to not speak much on founders, but also seeing the creativity within the LPGP community in terms of the different structures that, for instance, GPs have had to take on to make the investment opportunities more attractive to LPs. And whether that's blending the capital structure types that they offer these LPs, whether it's co-investment rights, you name it. I think that's what excites me. And it really shows that we can have a non-Silicon Valley model of drawing capital into the innovations that are popping up on the continent, out of the continent every now and then. So yeah, what was frustrating was that disconnect between perception and reality. What's exciting is that as capital allocators on the continent now, we have an opportunity to really reshape how we pull in capital and how we deploy that for ventures on the continent.
Thanks, Michael. So you on season 2 of Game of Thrones, right? The dragons are grown up.
I'll take that. Season 2. That's right.
And just for people joining, I also just want to give context on Delta 40 and a little bit about my background. So I started out as an angel investor, investing personal capital across the continent, and then I transitioned into a fund, and I started a fund with a good friend, Ali. Ali and I did Acacia Ventures, in which we invested in about 25 companies across the continent, probably covered about 12 countries. And we decided not to do fund 2, and we joined different funds, and that's really what brought me to Delta 40, which is a VC fund and a venture studio. And what really attracted me about Delta 40 was as a deployer of capital, you really started to see where some of the gaps were, where some of the portfolio support needed to be done, and then how do you also co-create with founders? And that's really what we're able to do at Delta 40. And really, going back to what Michael said, it has been sort of looking at a way of blending different parts of capital to be able to deliver that service. So delivering that service, co-creating, and actually creating our own companies where we see that there is a gap, and then actually deploying from our fund. So I have seen that there is this blended hybrid model of how we deploy and build on the continent that is going to be critical. And what I love about what EGLA is doing, which is what we're also seeing, is just working capital. Everyone needs to figure out a way to unlock working capital. As we deploy equity, we have to continue to figure out how to amplify that equity. And that's really the working capital piece. So I commend ACES for really putting this together. This is a really nice blend of different allocators. So super excited.
Biola, and
Thank you.
actually, you bring up an important point around blended streams of capital, and that maybe brings about a bit of complexity in the way you manage funds and investors as well. Could you maybe just touch on how LPs and GPs often misunderstand each other?
Sure. I think there is an agreement in that if you're investing on the continent or if you're building on the continent, there does need to be sort of a diversification of capital. We all know, we all agree on that. I do think that a lot of LPs are probably not built for some, I mean, they're sort of just not programmed yet for some of these more creative ways of raising capital. And so if, I've spoken to a couple of GPs and GPs want to do blended capital. There's some GPs that want to have permanent capital vehicles because we think those are some of the vehicles that work on the continent. At Delta 40, we've been able to have a fund, which is your traditional fund alongside a studio. And then we've been able to raise blended capital into the studio while we have a 2 and 20 fund that really works well for LPs. But as we have more conversations with other GPs and really trying to understand how they're doing that, what we're finding is that there are a lot of LPs that are willing, but they're either from an institutional perspective sort of not there or they're getting there. And then we're also finding that family offices, we're finding that HNIs are able to jump more readily into some of these more blended and alternative ways of how we fund startups on the continent. One of the things we're finding as we sort of bring up this issue around working capital and figuring out ways to bring in catalytic capital alongside our equity, we're finding that there are family offices that want to pilot different forms of catalytic capital alongside a fund that is 220. So I think this is just sort of a beginning of a different way of how we're going to create different capital pots. Would love to hear how other people are also managing that. I think that when you're also doing much more of creative or blended capital, it does take longer to fundraise just because both parties are also trying to understand. They're also trying to build the right governance structure around that. And so I think that if that's something that you're exploring, you just need to understand that it is going to take longer. And of course, we all know that fundraising takes long to begin with. So how do you also factor that into your fundraising journey? I think it's easier also for GPs that have sort of been on this journey for longer. Maybe if you're on your third or fourth fund, it's probably easier to do that. I think it's harder for emerging managers, but sometimes it's even better maybe to start with a complicated structure so that LPs kind of know, oh, there they come again. These complicated people that sort of make me do different things. So, there's never really going to be one way to skin this cat of how we grow and fund the continent. So we just all have to keep trying different things.
Thanks, Biola. Natasha, we were just talking, and you bring a very interesting LP perspective to this conversation. We're just chatting about how LPs and GPs often misunderstand each other or talk past each other. Just in your experience, can you maybe share some insights on how they do misunderstand each other and maybe how that can be avoided?
No, absolutely. And apologies for being late. I was on the wrong link, so I was waiting in another waiting room. I'm very happy to join this panel. Of course, I think in terms of misunderstandings, I think often we see that GPs, especially if they haven't fundraised from DFIs before, they think that we're sitting on a large pile of capital, basically, and it's a matter of tick the box, basically, an exercise of if I meet your mandate requirements, I should be able to get the capital, and that's a frustrating discussion, obviously. I always say this: I have tons of respect for any GP out there fundraising because it's a really tough landscape. It has been for a long time, but it's extremely tough right now. I think the reality is for us, like we're always looking at a portfolio perspective. Mandates change over time, and I think it's really more of like how do I construct a portfolio than a check the box exercise. So I think that's a common misunderstanding that I would note. And I think, yeah, I think their conversations do matter, right? So it is important to keep talking to kind of like understand better what is it that we're looking for. And I think also as investors, we have a responsibility to really also very clearly say no if it's really going to be no. That might not be a no forever, but at least for then the GP to be able to kind of really focus on those that can move further. Simply because again, it's a very time-consuming exercise.
Thanks, Natasha. Egla, from your experience in running Misfit Ventures, what are the common misconceptions GPs have about LPs' expectations?
The biggest one that I'm going to say is expecting that they understand your context. So I see this because this is what happened to me when I started fundraising for Misfit Ventures. So obviously we're doing private credits. Everyone intuitively understands, like Viola said, if you've been deploying capital on the continent, you know working capital is a massive issue. We all know the numbers, a $330 billion annual financing gaps for SMEs. You know, it's so out there that we thought as soon as we get in the room with LPs and we say, we're doing private credit, closing, you know, the SME financing gap, it would just be like, here's money, thank you, go away, goodbye. But it wasn't that. We spoke to so many LPs in the beginning who were, especially high net worth individuals, who were saying, this is not a real problem. You know, my partner, you know, needed financing for their small business and they were able to unlock capital. And then you ask them to unpack the story. I'll give you one specific example. We were speaking to a particular gentleman. He is a high net worth individual, has a private equity fund that he manages, but his wife has a dentistry. And she needed new equipment for her dentistry, and she's been managing this for a couple of years. She went to her primary bank and said, you know, can I have money to buy equipment? The bank said, no. And then she said, okay, fine, here's a personal, you know, guarantee. The bank said no. And then she said, here's my husband's personal guarantee. And then they said, yeah, okay, here's money. Um, and then when we asked him to unpack that, then he understood that the business didn't get money on its own merits, even though it should. It's a good business that's able to, you know, take this equipment and grow and repay this facility. But it was because there was a personal asset from a person with a large personal balance sheet that was able to back that facility. But what about the people who don't then have that personal balance sheet? What do they do? And there are so many people on the continent who don't have the large personal balance sheet and then are in that gap situation. So a lot of that taught me that don't assume that anyone has the context. Just always break it down and explain it really, really simply. It's the same way when founders come to us and they have a really interesting and out there idea. As an investor, sometimes you just can't even grasp how large the opportunity is because it's just so far ahead from where you are. It's the same way LPs, when we come with a really exciting new thesis, it's so far from their context that they just don't understand, and you have to paint the picture. So that's the one that I'm gonna share. Yeah.
Nice. Michael, just with your work at launch, what operational or fundraising hurdles would you say you see most often?
Yeah, thanks, Agwen. Insights being shared by my fellow panelists. I'd say obviously the perception and risk aversion is a big one. So obviously LPs want proof that fund managers can generate returns. Fortunate for Launch Africa Ventures, the two founding managing partners at Junaid have an extensive track record of building and running funds and ventures across the continent for close to 20 years now. For context, both former investment bankers here at Wall Street, Junaid used to run private investments at the Africa Development Bank as the chief investment officer. Zach, heavy on the accelerator side, one of the very early pioneers of international accelerator programs on the continent, looking at Tech Lab, which eventually became Techstars, and also looking at Africa. Startup Bootcamp Africa. So extensively, individually, they have a huge and very impressive track record. within the space on the continent. And that is one of the things that when you're speaking to LPs, they want to see is the fund being run by GPs who have a substantial track record, and have they demonstrated, especially looking at Africa as an emerging market, the capacity and potential to generate exits, which is a big concern for anyone deploying capital on the continent. And then I'd say another one that we face, to Viola's point, with regards to how difficult it's been raising capital, and especially within the last 3-4 years, is the fundraising cycles and the capital dry spells. So, looking at the global VC downturns, looking at macroeconomic shocks, whether it's inflation, whether it's currency depreciation, and so on and so forth, that poses as a hurdle to a lot of fund managers as they navigate the fundraising environment. And then obviously looking at governance, which is another significantly big area where LPs, whether locally using that term loosely in relation to African LPs or African-based LPs, or international LPs, are considering when looking at fund managers or looking at fund opportunities for them to deploy capital in or through. I'd say those would be among the top 5 in regards to what we've seen, Abu. So you have the perception of risk, and obviously the ability to demonstrate liquidity generation. For our Fund 1, we are currently in our 5th year of operations, so 2nd year of harvest. And it's what we're experiencing with our 200 plus LPs that put capital with us in Fund 1. And so the opportunity we have now is to demonstrate that we are able to generate a healthy DPI. And, fortunately, we're in the process of doing that and clocking our first capital return event for our LPs, which is a good signal, not just to Launch Africa Ventures or for Launch Africa Ventures, but I believe to the broader ecosystem in terms of private capital can be put into VC across the continent, and it can generate, healthy returns for all investors. So that's risk perception, demonstrating the ability to invest, obviously, and then generate returns. And then obviously looking at the resilience to survive various market cycles. And that is your VC downturns, macroeconomic shocks, and so on and so forth.
Thanks, Michael. You've touched on this, and maybe I want to get Natasha's view of how institutional investors view Africa today. Could you just give us some insights? Are there any changes in views? Are you seeing any time-specific decision-making on Africa and African funds?
I think there's actually something that's also linked actually to the earlier discussion on misconceptions as well as on blended capital, because I think another misconception is that we can do a lot of this from balance sheet, right? Like actually for a huge amount of DFIs, the reality is still such that we ourselves need blended capital to be able to do VC investments in Africa. And this is a huge concern, and that has caused some of the dry spills that are partly obviously due to the macroeconomics, but also partly due to kind of like funding waves in terms of if the DFIs have the capital to deploy, because I think the particularity of the African ecosystem, unfortunately, while we do see funds like Launch Africa that are very well able to attract private capital, this is not always still the case, right? There's lesser investors in terms of a variety of investors, perhaps from the private sphere that we do aim to attract, but obviously need to see the returns for that. I think that also, speaking for most of the DFIs, I think we get more and more scrutiny on our fund investments. So just saying, okay, we're generating impact is no longer enough. So I think where previously we lived in a world where if you had a GP-LP relationship and you would just go into a third fund naturally because you did the first and the second, today that's just simply not good enough anymore. So the scrutiny on actual performance, on actual liquidity is much higher. And I would say that unfortunately that also comes in a period of time where liquidity is difficult, right? There's been less secondary availabilities, and in that sense we're putting a lot of scrutiny. So we're looking much more DPI, actual exits. But the way to go about that as well would be, for example, to go really line by line, and the fund manager saying, okay, of your investees, how much capital have they raised subsequently? How healthy are these companies? Like, where can they go next? If there's no actual kind of exit events yet to show, that is a way still to kind of understand really where the portfolio sits. And as was mentioned before, I think really what we're looking for is very strong partners in those fund managers, people that can really carry this forward for a longer period of time, that are firmly kind of motivated and understanding what they're doing. They have a good actual understanding of the portfolio that they sit on, and a good network with the companies in the markets where they operate. I think these are key differentiating factors that we really look for in most of the emerging markets, but specifically in our Africa VC investments.
Good, thank you. Biola, I want to come to you, and maybe you've touched on this with your work at Delta 40 and Acacia. Just wanted maybe if you could share some insights on the lessons you've learned from building and backing startups, and do you think fund managers should integrate into how they design and pitch their funds to investors?
Sorry, I lost the first part of that. Can you just
So, yeah, what lessons from building and backing startups do you think fund managers should integrate into how they design and pitch their funds to investors?
So it feels like a lot of what people have said, but I think that in just sort of looking at where we are from an ecosystem perspective, one of the things that is really important for all of us to also recognize is that VC is still quite early in the ecosystem. And I think that at the very beginning, I mean, a few years ago, one of the biggest challenges that GPs and LPs had was actually deploying. So a lot of our ecosystem is actually designed today for deployment, not for exit. And so I think that there has to be a re-engineering of how we think about how do we exit and provide liquidity, and how do we drive towards DPI. And I think that this has been a lesson in the beginning in sort of when I first started deploying capital, was just sort of like, how do we get in? How do we structure these? I mean, I remember going to early angel meetings with most of the people that are now GPs, and we were learning how to design safes and these CPNs. So I think that it is important also, like, just as a GP/LP community, we also sort of recognize that. And so in sort of today, I mean, I think that the question we're asking founders, and we're also helping co-design, is who are the buyers of these businesses? Where are the exits going to go? Where are these exits going to come from? Who are the strategics that we can start talking to from the beginning? And then who are the strategics that we could actually bring into those conversations as we also meet with LPs? I think these are different ways. These are new ways that everyone is sort of looking at their portfolio. As you look at portfolio construction, where and how are you going to actually get the exits? Where are those relationships? What are some of the expansion plans? I mean, I think that once again, early on, there wasn't a lot of calculation baked into the type of volatility we've seen on the continent in the last 10 years. Even though we always knew, we just sort of didn't, we always thought that VC companies would outgrow that type of volatility. And we did see those things happen and get hit. So now we ask those questions. So I think the natures of the questions have changed. And so how you invest and how you build companies have to also change.
I want to add to what Biola has said, because I think this question is very fitting for how we approached fundraising. So when we started raising for Misfit Ventures, we were always very clear that this was a proof of concept fund. And that mandate allowed us to be able to kind of play around and try different things. And when we set out, we had said we were raising $5 million to do this. And in the international worlds, that is a micro fund. But in South Africa, doing local currency debt, that is 100 million rand. That is a very big fund. So we found that actually we needed to reduce that even further to $2.5 million, which is 50 million rand. Still quite a big fund, because actually in South Africa, for context, a small proof of concept fund would actually be about 20 million rands, which is about $1 million. So playing with the conditions on the fields to say, okay, internationally, this is what a small fund is, but actually the conditions on our field in South Africa are different. So adapting that has actually allowed us to raise from international high net worth individuals and then unlock pools of local capital. And now we're in a place where we're able to, have quickly raised the 50 million that we're trying to raise, and then deploy it in a really strategic way to then build onto that to raise more capital later. But then we rather, use the strategy of, do a really small thing, prove out the concept, because that's what we set out to do, and then grow up. So really meeting those conditions on the fields, raising where we could and leveraging the high net worths to unlock larger pools of capital, looking for local pools of capital, which, in South Africa, we're blessed that there are institutions that are looking, to do inward investments that are looking at South African businesses. So, yeah.
Yeah,
But can I
thanks,
also
Agla.
add something like to this discussion? I think what's also important is the whole discussion on exits and liquidity, which again, I think at least on the equity side is really what we're looking at for venture funds. It's really changed as well, right? I think a few years ago, like the perception was still like, no, you need to sit on it if you still think that it's going to create a higher value, etc. Like sky was the limit, basically. I think those realizations have come down tremendously, where we're looking sometimes really more at kind of like more mid-cap kind of multiples and just saying like take any money off the table to show liquidity rather than wait until the very end. So this is a discussion we more recently had with a number of GPs as well, where I think this realization shift has really kind of emerged just more recent.
Natasha, maybe could you give us what multiples are you referring to? Is it 3, 4 times, 5 times? What sort of multiples is that?
Look, I think traditionally, obviously, we're modeling VC according to what's been seen in Silicon Valley, right? And just saying, okay, we're going to assume that here we're going to replicate this fund model where there's one or two basically outliers, maybe doing 10, 20x, and then the rest could fail. And that's not what we're seeing. We're seeing actually that most of these VC funds should function or are functioning effectively as more a PE fund, needing much more moderate multiples, but kind of like across the board, a much better performance. And therefore, you need companies that turn to profitability as soon as possible rather than just kind of like boosting the upside. And I'm not saying that we should cap companies, right? Like there is obviously tremendous opportunities in Africa that have that capability to grow beyond the multiples that are more on a medium scale. But it's just to say that I think on average, saying like, okay, if I have a buyer now, I'm taking at least a part of my money off the table and I get something back and get some DPI to my investors. Because if we're talking about fundraising, then I think that's what today requires, and I don't think that was the case in the past few years.
I want to add 3 data points to what Natasha has said, because this is such an important point that I agree with. The first point is DP World, a global port operating company, was in the market looking for an African partner, and they acquired Imperial Logistics. Imperial Logistics, at the time when it was acquired in sort of May, March 2023, was a multi-billion-dollar business operating out of South Africa, but one of the top 29 logistics companies globally. DP World paid $890 million, not $1 billion. Imperial was not a unicorn. Okay. And then a fund manager I know spoke to a few of the financial institutions locally here in South Africa, and they all expressed that any business that is more expensive than 250 million, they will not even ask follow-up questions. They're just not interested. And then I spoke to the lady who led the Nedbank acquisition of Ikoka, which is a fintech specifically focused on SME financing here in South Africa. And Nedbank paid about $100 million for that. And that's about 1.2 billion rand or so, 1 billion rand or so. And she was telling me, we rebased the market. We completely changed the way that acquisitions are being done. We paid such a premium for this business, and it's $100 million. So if corporates are thinking $100 million is rebasing how the market is working, then we really need to think about, when we think a startup is going to be a unicorn, what are we saying? You know.
Thank you, Egla. And I mean, just to boost that, I was having a conversation with a GP yesterday, and we were talking about, early stage investing and where they sort of look at some of their exit points. And they're very comfortable with 100 million, 200. I mean, he's like, look, 200 million, I'm done. I'm definitely taking this bird in hand. And we always popularly say a bird in hand is the only bird. So, I mean, I think that we're going to see more and more of just how do we return capital, because I think we as an ecosystem have to show LPs that we can return capital over and over again, and it's not a fluke. And I think until that sort of becomes part of the DNA of investing in Africa, we're always going to struggle to fundraise when we go out to market. And so, yes, we're going to have some outliers, but most of our companies, I mean, they're going to be three, four market companies, and we're going to exit sort of in that 150, 200, 500 million range. And I think that a portfolio should have a mix of that. And we should also have the ones that we bet big on. But I just don't think that it is going to be everyday occurrence for us in the same way it is for bigger markets. We're just not there yet.
Yeah, super exciting chat. I think this is a very important point, as you say, Egla. Michael, I want to maybe come to you and looking for more tips. What approaches have you seen work that have turned challenging pitches into longer term relationships?
Yeah, thanks, Abu, and lots of incredible points being shared by Egla, Natasha, and Biola. And maybe just before I answer that, Abu, I just want to touch on the corporate bit that Egla brought on. And one of the things we are doing with our portfolio at Launch Africa is really orchestrating that end from the beginning. So when we start looking at potential investments, we are looking at, okay, how does this fit into the broader portfolio that we are constructing? I mean, Fund One only has 133 companies that are covering 22 markets, and we did a total of 15 different sectors. And that is a carefully orchestrated investment strategy in that we are not just deploying capital, as we like to put it, but really strategically constructing a tech portfolio through disciplined investments and data-driven decisions, and intentional ownership in some of these companies that we take ownership in, or we take control in terms of how close we are with portfolio founders, and maybe breaking it down in terms of our targets, stage, geography, and priority sectors. So if you look at the stage, we do pre-Series A to Series A. If you look at how we split the capital allocation, obviously 50% of our portfolio of our capital is allocated to seed stage companies. We have a 15% that is reserved for follow-on rounds, because the idea is really, when we started Fund One, to get the companies successfully through that valley of death. And then obviously we have a small allocation for pre-seed companies, which are on the very early spectrum of the investment scene. Geographically, obviously, we cover four, or rather five, if you look at Francophone and Anglophone West Africa. And then priority sectors, we're looking at AI, machine learning, e-commerce, fintech, edtech. By the need market. And so looking at that, as we are now constructing Fund Two, being very intentional to ensure that, one, we're building, carefully building one of the largest community of founders across the continent. We have over 200 founders on our founders platform. And then how do we strategically orchestrate synergies within the portfolio in the community we've built? We see founders not just sharing knowledge across the businesses, but founders also supporting each other with market expansion and insights. And obviously, when you look at the data side, we have one of the most comprehensive data set benchmarking, revenue, growth, success rate, and so on and so forth. And obviously, you have the impact, which is a direct and indirect achievement when putting capital to solve some of Africa's biggest problems through our founders. And so touching on the corporates, one thing we're doing is working with corporates that we've seen have an interest in solving some of the legacy challenges they have across different markets. And then with the end in mind, sort of orchestrating a potential M&A activity. And the way we are doing that is first and foremost by understanding the pain points of these corporates and then testing out the appetite to try and solve their challenges by partnering with a portfolio company within our portfolio. And what that is doing is, one, it's lowering sort of the, if I can call it, the bar of risk that the corporates usually envision or think of when they're working with, startup companies. And then by carefully managing that relationship, we can orchestrate a potential exit for us. And obviously there's a benefit to the corporate in terms of solving a pain point that, given how big they are and how slow, forgive me for using this, if there's a corporate in the audience, how slow they tend to move in actioning some of the solutions they need for their challenges, then it becomes a low-hanging fruit for them. We've done this with a notable number of corporates, big groups that have different facets under the groups. And through our own portfolio companies within different sectors, we've been able to match and mix and make introductions. And we are seeing a number of them getting some of their problems solved. Obviously, it will take time. And as they understand how the startups work, and as the startups also understand how to navigate the relationship with some of these big entities, we are expectant that it will unlock some type of value in terms of generating liquidity for the fund, which again is good for the ecosystem. Now, to your question, Abu, in terms of how to turn challenging pitches to long-term relationships, one thing we've done is really allow for co-investments with some of our LPs, allowing them to come on in deals where Launch Africa has come into. And obviously, because we come in quite early in the deals that we tend to back, we get preferential terms, and it's preferential based on agreement with the founders. I'll give you a context in terms of numbers. I think we did our impact report a few months back, and for every single dollar that we invest as Launch Africa, we have an additional $4 invested in terms of venture building support. So that handholding, how do we help our founders with scale? How do we help them with talent? How do we help them with capacity building? All the necessary tools that they need to grow in their beachfront markets and then scale beyond. And so because of that, it's really a partnership with the founders. And over time, if I can give you figures from Fund 1, we've seen within 4 years of our Fund 1, over 60% of our portfolio companies successfully raised follow-on rounds at significantly higher valuations than we came in. And if you look at the number of businesses that have, obviously given the macroeconomic conditions, have become operationally dormant, we're only tracking out of 133, we're tracking 9%. And then obviously we have a small percentage of the ones that we folded for various reasons, but the biggest being challenges raising additional capital to keep the lights on. And then 26% or thereabout of our portfolio is running at book value. So really emphasizing on providing that opportunity for LPs to co-invest, have some skin in the game, understand how we invest, how we add value beyond capital. And obviously it goes without saying, speaking to niche, right? For instance, as Launch Africa, we have a focus on B2B or B2B2C, asset-light type businesses, and being clear about that niche when presenting opportunities to LPs makes it easier for them to make a decision on whether to proceed with you or not. And then obviously high quality updates, right? And the frequency of these updates, whether it's through investor newsletter or thought leadership or sectoral information for sectors that whichever LP you're speaking to cares about, that just keeps that relationship warm, and it de-risks a lot of these misconceptions and perspectives that an LP might have. And we've seen LPs come in. We have LPs who started tracking Launch Africa Fund 1 in 2020, and they've only been completely comfortable coming on as LPs in Fund 2. And so within the last close to 6 years, they've seen how Launch Africa invests, the relationship with founders, and obviously the impact we've had as a fund on the market. I think just to highlight two, Abu, it's that clarity in terms of your niche. It's allowing for LPs to test the waters with you. And obviously this might be unique to Launch Africa, given that we are largely private capital backed. And then similar to founders, how do you keep LPs engaged, right? How do you provide them insights into the various sectors that you invest in? And what's the quality of that data and insight you're providing to them to give them confidence that you're not only just good at deploying capital, but you really have a grasp and proper understanding on the markets and the type of investments you're making in these markets.
Yeah, interesting, Michael. And Bjorn, I want to maybe come to you now and maybe expand on this relationship concept. And if you could just give us some insights on how you build trust with global LPs who may be skeptical of risk in the African market.
So I mean, I think in just any relationship, trust is a something you build over a long term. But what we have found is number one, tapping into our networks, really keeping people and keeping them in our information loop. And every single time we get the opportunity to really just have open conversations. And so even for the investors in our portfolio, we have quarterly investor updates. We also invite investors to actually invite other people, and we send investors reports out. We have found that, especially because we have a lot of family offices, we have a lot of HNIs in our portfolio, it's really been important to bring them along on the journey. We also plan trips for LPs to come into market, people that have never been to the continent before, and then turn them into advocates, and then making sure they meet founders. A lot of LPs come in because they want to see impact, they want to meet founders, they want to meet dynamic people. We also have one of the things we've also been able to do with our fund is actually bring in founders. So we've also brought in founders. So some of our founders have actually become LPs in the fund. And so I think that also changes the dynamic and the storytelling. And that has just been from us investing and them seeing the type of support we really provide and the engagement. And so they've come into our second close. I think these type of stories for people to I think sometimes when we tell the story, people are very surprised. Investors or LPs are surprised that African founders are also in our fund, and founders that have had exits are in our fund. And I think that this is a changing face of capital on the continent that people need to see for more people to bring capital into the continent. And so I think for us, that's been a really amazing way to build trust, is actually just making sure LPs meet other LPs that are already in the fund. Once again, reporting, transparency, governance. We have a board, we have regular board meetings, we have board reports that are available. I think these really help investors understand that we're building something that will outlast us. And so that we're not just this is not a temporary profession for us. We're really taking this as our future, and we really want to see the continent transform. And so for us, we're building a legacy business, not just really sort of like a pass-through business. And I think when people see that you're passionate, that we're really Natasha said this at the beginning, it is hard fundraising. And so the fact that we're going on this journey and we're repeating this day in and day out, and we have other people that are joining us on this journey, I think this is what really is helping us build trust with LPs.
Yep. Abu, can I maybe just add a data point there, borrowing a leaf from Egler? I think there was a report last year by AVCA that demonstrated or showed the average holding times for VC investments in Africa versus globally. And I think the average for Africa was about 3.8. And looking globally, I think the average was 5, if I'm not mistaken. You can clarify that for yourselves. The report was by AVCA. And so that's 3.8 years compared to 5 years globally. And so that speaks to the ability for quicker turnarounds that are being reflected on the African market. And obviously, a majority of that is driven through secondaries and trade sales compared to what we're seeing globally. And so that data point goes to speak to the opportunity of exit in Africa, which is a big question mark when you're speaking to LPs about investing in a VC asset class in a market like Africa. And another data point that I think is very important, speaking to exits and also the opportunity, if you look at Africa, data points to Africa being the final frontier in terms of markets globally. If you look at India and Latin America, Africa behind about 5 years to where these two markets were, 5 years ago. And so it's an inflection point where we're seeing increasingly fast uptake in VC as an asset class, comparatively as an opportunity looking at other markets. And maybe just to drill down a bit, you're looking at 1 in 5 people globally being an African within the next 25 years. And of that, you're looking at a population that has over 60% of its demographics under 25 years of age. And so if you look at the positioning from a macro level, if you look at the big techs and you look at global companies that are increasingly pivoting to set base in Africa, I think just that fuels, or it should fuel, the confidence in that the opportunity is here, and it's demonstrably, in terms of return on investments, backed by actual real figures and numbers.
Just to add to Michael, Abu, I mean, I think, you and I have been angel investing for a long time. I have to say, I'm not sure. I have not met a founder in the last year that has not already raised local capital into their venture. This is extreme. I mean, the local capital is showing up every day across the continent. And I think that this is showing that there is huge belief in from the people that live on the continent, in the continent. There is innovation, I mean, once again, growing and higher efficiency, capital efficiency, some of it by necessity, but over the last few years, you have seen Africans build with a higher efficiency than most other places in the world. So if you look at the dollar per unicorn raised and built, Africa is showing much more efficiency than most places in the world. And I think these are all the things that are building trust from a macro level in the companies we're building. And even in the countries that have experienced high currency devaluation and volatility, we have continued to see incredible multiples from high growth companies that have also once again boosted just people's confidence in the continent. So I think that, I think it's really just getting people over the hump. I think once people see the numbers and and we build that confidence, I think that we will continue to see this tide turn in our favor.
Absolutely.
Yeah, I think we are just about to close down the discussion, but before we do, just to remind the audience that there is a Q&A facility that is available to you on the Zoom call. So if you do have any pressing questions and you'd like me to share them with the panelists, please include those questions on the Zoom facility. While we wait for
Sorry,
those.
Abu, if those questions are directed to people, we can also answer them. There's an answer facility. So if you direct them directly to any of us, we could also try to answer them just to save time.
Yeah. But maybe while we wait for those questions to come through, to the panelists as a whole, looking ahead, what systemic shifts, policy, capital flows, fund design do you believe will unlock the next wave of fundraising opportunities in Africa?
I don't think there is, well, I'm going to speak for myself, but I think there are really interesting models that are being tried and tested in the market from different fund managers. We did the 2X Ignite GP Accelerator program, for example. And I speak to a lot of emerging fund managers, and there are really interesting approaches that are being thought about, that are being workshopped, that are being reiterated on. So I don't know that we can necessarily point to one really one strategy that is going to be the future. I think it's going to be many different approaches, some localized, some more Pan-African, some maybe starting in a local way and then expanding. But it's more exciting that these thoughts are percolating across the continent.
I think in terms of strategy, right, we're already seeing now there's like a lot of capital going into clean tech, right? So almost maybe disproportionately to the opportunity sometimes. And I think that maybe over time like gets more neutralized. I mean, obviously not saying that we shouldn't invest into clean tech and climate is a high KPI for Proparco as well. But just saying it's quite nascent in terms of some of the underlying business models that we're seeing and then there's a lot of capital attention for it. And I think then maybe over time, I mean, there's been a lot of discussions with the GPs, also in our portfolio, outside of our portfolio, about like, is the traditional fund model still working, right? And I think it is still hard for some LPs to basically go into kind of more alternative structures, even if maybe for some underlying instruments that makes more sense. And I think that continues probably to be a discussion. I think there's a lot of terms underlaying that have given a lot more leeway, I think, for the realities of venture capital. But there's obviously tension still between fund structures and particularly the costs of funds that are being scrutinized. And I think where we hear a lot of fund managers say, like, can we not just start with doing these funds at like 14 years because we know actually that it takes a lot of time to basically return the capital. There's a lot of discussion about liquidity. We're saying, well, you know, that in terms of cost, it's going to be tricky unless you can do it on a very, very, very low fee base to basically get the returns then that are needed and required to keep on investing into those funds. So I think that tension is probably going to continue to be a bit the case. And then, I mean, obviously we'll need to see where policies are going, right? There will be perhaps some discussions in the future about like whether or not DFIs need to think about better certain countries' interests are in certain mandates. It's not really currently the case, and I hope that we can continue to invest, and we as Proparco can invest currently in a large scale of subsectors, and I hope really that continues to be so, but I could see that could narrow down depending on where politics are going across the globe. So this might be another thing that will affect the fundraising world.
We are starting to see questions come through. Bjorn, I see you are taking the question addressed to you. But if I could ask the other panelists to also maybe pick up some of the questions. We do have time to maybe address one live. And I'd like to take the first one that's come through from Anthony. The question there is, what are some of the differences and similarities between Silicon Valley models of raising capital and African ones?
I mean, the most immediate one is Silicon Valley or the US is a really interesting market where, you know, one currency, massive population, almost 300 million people with a similar currency, much larger relative wallet sizes if you compare, for example, e-commerce to emerging markets. So, you know, you're building then in an ecosystem where there's basic infrastructure, very, you know, deep pools of capital where you're able to maybe just focus on your niche product and grow that and scale that quite quickly because you have the supporting infrastructure versus startups in Africa don't necessarily have that. First of all, there isn't unrestricted capital. The minute you're getting, you know, that investment, every investor is looking on the clock and, you know, basically counting down for you to say, you know, where is my return? Where is that exit? So we don't have the luxury of an Uber, for example, to say, we don't know when we're going to be profitable or if ever, and the capital is always going to be there. In Africa, the taps are unfortunately going to be closed, you know, sooner rather than later, or sooner than you would want that to be, unfortunately, because that's just the nature of the market right now, because of also pressures from LPs. But anyway, and then of course on the other side, with regards to, you know, just building in an ecosystem where you don't have the basic infrastructure. For example, I'll give you a non-tech example. I was listening to a podcast recently, and they were discussing the challenges of why McDonald's has not set up shop in Nigeria, the McDonald's, the franchise. And the challenge at the time that was intimated by a PE investor that was close to that situation is because there was not enough of the supply chain infrastructure. For example, you know, adequate roads, cold storage, facilities, and things like that. And that's why McDonald's was not able to go into the market until now, because there needs to be that infrastructure investment. So if McDonald's, a global multinational business is having these challenges with infrastructure. How much more is that true for small startups that are trying to digitize a specific vertical, but just don't have the infrastructure to rely on at different points in their journey? So it's a big challenge as well.
Thanks, Egla. We are over time, but I'd just like to ask one last question, if you wouldn't mind staying with us. Just if you could, and this is to the panel as a whole, if you could provide one tip or pointer to anyone raising a fund at this point in time, what would that be?
Patience and resilience, but also what was said before, right? I think offering co-investments is a really good way to get to know your LP. I think that could create a fantastic base to work together. And as said before, sometimes it does take 3-4 years before an investor is ready to step in. But these continued discussions are very important, and working together on co-investments are very important. And super quickly, another one, I think there's a multitude of small funds being raised currently, and that's super important, of course. We need local fund managers really know their home markets. Nevertheless, for some of them, they're just going to be subscale. They might need to partner up with another one to just create the scale at which they become attractive to the larger investors. So I think that would be another tip that I would give, as hard as that may be.
I guess my tip would be know your audience. Like what Natasha said, if you have a subscale fund, then, don't necessarily go and talk to every DFI out there. They're not their audience. They are not your audience, So knowing that and saving your own energy as well to structure your fundraising in that direction. But then a second one would be to lead with curiosity. Ask the questions, what is your appetite? Are you deploying? Do you invest in Africa? What is really exciting for you? So yeah.
Yeah, I can add to that. Sorry.
Go ahead.
I mean, in addition to knowing your audience, I'd say building trust through consistency. So whether that's regular reporting, delivering on what you promise, being honest about failings and challenges, it's a big, small ecosystem. And, the success of one builds onto the success of many on the continent. And I think to your previous question, I would just to put 2 points across what I believe will unlock the next wave of fundraising opportunities on the continent. I think seeing more domestic LP participation, and especially from pension funds, insurance companies, and sovereign wealth funds, which we are seeing increasingly in growing numbers, I think that will reduce the dependency of foreign capital. And that speaks to that point of the significant differences between Silicon Valley models versus the African models of fundraising. And then I think the other one would be more innovative fund structures. So whether we're looking at evergreen funds or mezzanine funds or growth stage funds, to ensure that we have, vehicles that are bringing seed stage companies to scale. And that obviously creates more opportunities for liquidity events, whether through secondaries or M&A, which again benefits not just a single entity, but the entire ecosystem as a whole.
I think just know that this is a long game and you're building relationships, and really understand what fund you're building at any given time. And just know you're building relationships with founders, you're building relationship with co-founders, you're building relationships with co-investors, and you're building relationships with LPs. And know the right LP at the right time, but always be building relationships with LPs. LPs also move from fund to fund. Sometimes they leave their fund and go to fund of funds, and it might then be the right fund for you. I mean, we had an LP that was at a DFI, and now they're at a fund of funds, and they're deploying into smaller funds. And now, they called us, and now we're having conversations. And so, just know that you're building relationships for the long haul. And sometimes we can forget that when we're in the weeds and we're just sort of like going pitch after pitch. But just once again, take time to reflect and just continue to build the right relationships that are good for you. And know your market. I saw that someone said, aren't we trying to build companies from Africa? Yeah, but Africa also has a lot of challenges that need to be solved here. And a lot of the companies that have been building and have had a lot of success have actually built not for the world, but for Africa. So started in small countries and built across Africa. So once again, know your market and know what you're selling as you're out there. But really, I mean, wishing every single GP on here all the best. It's a haul. And have GP friends going through the same things. We tell founders, create your own network and your own ecosystem. Have good GP friends you can call and vent sometimes. So good luck, everyone.
Thank you, Viola. To you too.
Yeah, that's a really insightful closing comment, Biola. Thank you so much. Egla, to you too. A big thank you, Michael, Natasha. A big thank you to all the panelists for staying with us beyond the scheduled time and for sharing your insights. Really interesting to hear things from both perspectives. And from the ACES team, we thank all the audience members for staying with us this afternoon and joining us on this conversation. And we look forward to the next discussion.
Thank
Thank
you.
you, team.
Thank you.
Take care.
Thank you.
Bye.
Bye.